is John Browning. I'm Managing Director of Bands Financial, and this is the third of a 3-video series of trading the Chinese commodity markets. And this one is concerned with the matters arising, or the trading issues arising within the Chinese futures markets. Now this video is appropriate to both small and large investors, and particularly high-speed investors who may write their own software to the Chinese futures markets. So I'm going to try and outline some of the issues that you should be aware of. In previous videos, part 1 looked at Chinese futures markets and gave the background in that. The second part looked at the available routes into the Chinese futures markets. And this one, as I said, will concern itself about the matters arising and the issues of trading in the futures markets currently. Now, most people who look at the Chinese markets are looking at the potential arbitrage opportunities. And that is because the regional commodity prices depend on location, quality, and prompt date. And consequently, commodity prices are driven by a different set of regional dynamics. So the dynamics here in China are different to those in the US or Europe. And earlier we outlined that indeed the commodity price in China has recovered, the economy has recovered, and that is not in the same step as elsewhere on the planet. This video is being made in December 2020. It's been a momentous year, and in many ways the trends that we've seen emerge in 2020 are nowhere near finished and very difficult to perceive whilst we're here on the ground. But however, one of the key things that's happened throughout this year has been the access into China to trade the Chinese markets has continued to increase. Now, as we outlined in one of the earlier videos, the access to trade iron ore was in May 2018. Access to trade crude oil was in March 2018. However, the uptake by international investors has, in the first 2 years, been relatively limited until the middle of this year, until the middle of 2020. And I think one of the reasons of that has been access. Prior to this year, the only way to access the Chinese commodity markets was basically using a Chinese front end, a Chinese trading platform. And many, over the years when I spoke to various investment banks or traders or merchants, consumers, etc., outside of China, when I said, well, it's easy to access these markets, however, you need to have eSunny or ATP, they usually said, well, they would wait for a Western piece of software to emerge. And that is what has happened most recently. So, trading platforms that are available are basically the Asian ones, eSunny and ATP from China, TradeX, and there's other broker-supplied alternatives. But more recently, we've seen the Western ISVs, including CQG and TT, take a step into the market. So now that these Western trading platforms are available, it has generated a completely new awareness of being able to trade into the Chinese markets. And it's creating an awareness of the huge volumes that are traded in China, as we outlined in the earlier videos, where we said that 1 in 2 commodity futures contracts, is actually traded in China. It is half the global total of commodity trading. So there's this enormous liquidity, and investors are now, or foreign investors, are now becoming aware of it and want to participate in it. So in addition to these ISV platforms, there's a series of APIs that are available if you're using Bains Financial in Shanghai and Hong Kong that would allow high-speed traders to access the market. And co-location is available via Bains in Shanghai for I&E products. And we're working very, very hard to deliver co-location on DCE products. Now, what I need to do is talk about some of the trading boundaries that we have in China. Now, China is different to the international markets, has a different starting point. And there's no point in saying, can these be changed? They cannot be changed. This is what the government, what the regulator requires, and it's completely different from what you have in the Western exchanges. So, at the outset, we should review the trading limits and margins that are used by the Chinese exchanges. Now, these are different to what you are familiar with in the international exchanges, and therefore you need to be aware of the issues that arise. So there are basically four parameters that we should discuss. First of all, similar to other exchanges, I suppose, there is progressive initial margin limits towards expiry. So that means that towards expiry, the initial margin rises quite sharply. And so what might be 5% initial margin in 3 months' time rises to 10% when it's 2 months away, and 15% when it's the spot month, and maybe 20% when it becomes close to cash. Now, that means that there is a particular feature of the Chinese markets, which is that the main traded month tends to be about 3 months away, 3 months from today, because it has the cheaper, the lowest initial margin cost. So the traders tend to roll from the second to the third month to keep their initial margin costs lower. The Chinese futures markets have limit up and limit down, and these you should check reasonably frequently because these do change. And whereas the limit up, limit down might be, say, 5 or 8% from yesterday's settlement, they then moved slightly broader on the second day and slightly broader again on the third day. So, and each market is slightly different, but they employ limit up and limit down, similar to many exchanges around the world. Unlike other exchanges around the world, the initial margin calculation is completely different. And they use a one-side larger amount initial calculation. Now, I'll try and explain this. And it's unlike the span margining that you see in the international marketplaces. So for example, if you open a position for 9 lots and you go 9 lots long, you'll be charged an initial margin for 9 lots. If you bought another 5 lots, but for a further month forward, you would be charged the sum of the two, so you would be charged an initial margin of 14 lots. However, had you sold that forward month in Western markets, you would now be long 4, or you would expect to be charged for 4 lots. That was the 9 lots you were originally long, the 5 lots you sold, the net is 4. That is not the case in China. They will not give you a 4-lot initial margin calculation. They will remain at 9. They will take the largest of one side. So your initial margin calculation, in this case, the largest side being the 9 lots, that is what you'll be charged. And there is, although this is unusual from the perspective of Western traders, it is the way that the the Chinese exchanges work, and there is no changing that. The other thing is it works on pre-trade margining, so that there is no credit given to futures accounts by brokers at all. So traders have to pre-fund their account before they trade. Now, for us at BANZ, we see this quite frequently, that we are receiving money from the treasury of our clients prior to them starting to trade a particular strategy. It would seem that the traders and the treasury are very much work together. This is unlike Western houses that we know, where the traders start to execute and the treasury funds the positions maybe the following day. That is not the case in China. If you're looking to open a new strategy, you have to fund it first, then send the orders in to execute it. Without that, your order will be rejected at the exchange level. There will be no way through for you to get your strategy executed without the money being present in your account. So, I now want to cover some of the common trading issues. And the most important, I think, of these is wash trades. Now, wash trade occurs when a client company trades with itself. So typically you might have a trader in your company places an order to buy one lot of X, and another trader doesn't know that trader is trying to buy there, sells one lot at X and creates a wash trade. That company has traded with itself, as the regulator can see, because everything is trading through your one client code, your one number that has been issued previously, when we covered that in the second video. Now, opening a wash trade is a very serious offence in China and should not be done. So there are a number of ways to lessen the chances of that, and typically that would be that the ISV or the software that you use has a means of looking at the trade, looking at the client's, your trader's orders, and will prevent a wash trade going to the market, because it would know that there's already a trader with the opposite order there. Now, that is if your software can do that piece of work. Now, the Chinese software does that piece of work because they've been in this market a very long time. But it may be when using new software that's come to the market, to the Chinese market recently, then they may not have this issue solved. The other thing is, if you're writing to the API, you might not have that issue solved at all, because you're going to have to do it yourself. So you need to stop wash trades going into the market. And one of the other issues that I would point out here is the only way to stop traders trading with themselves is to put them all into the same sort of trading bucket, so to speak. But it may be the case, certainly with some software, that a spreader, using a spreader, an auto spreader, is in a different bucket to your manual traders. And so the spreader could possibly hit your manual traders. So you need to be very careful on the way that that's set up to make sure all your traders are in the same group and that the software is there to prevent them creating a wash trade. It is a regulatory requirement. It's a regulatory problem if you break that rule. So, following on from wash trades, open-close order takes. Now, this is an issue that arises in sending an order into the exchange. If you send an order into the exchange to buy 20 lots, it should have a tag on it saying buy 20 open. If you go on to sell 5 lots, it should say sell 5 lots close. If that happens, then the position will go down to 15 lots in the exchange. It will close off correctly. If you don't do that, and the second order, your closing order, goes in sell 5 lots open, your position will not close off correctly, and you in the exchange you'll effectively have buy 20 lots open, sell 5 lots open, and the initial margin you'll be required will still be 20 lots. You won't have closed off the position at the exchange level correctly. Now, this isn't a regulatory issue, so this isn't going to be a problem with the regulator. It is just a problem at the sort of exchange level clearing. And so you will continue to be charged initial margin of 20 lots, which over a period of time, if you don't pay attention to this, is your initial margin will be rising and rising and rising, and none of your buys and sells will be settling at all. So it needs to be addressed. Now at the sort of manual level with manual traders, it's an issue that they can manage. But once you're trading with spreaders, you need to start thinking about using an automated way of knowing whether the next order you're putting in is an opening order or a closing order. Now some, as I said, spreaders are able to do this. You know, the Chinese platforms do this on an automated basis, but on new software coming into the Chinese exchanges, they may not be able to handle this, and you need to be aware of it, especially if you're writing your own software using an API. Again, if you're writing your own spreader, you need to figure out how to manage the open close order tag issue. So, order to cancellation. Now, all the markets have a order to cancellation ratio, and it is reasonably low. So it might be 300, maybe 500 orders you are allowed to cancel in any particular day in any one particular contract month. So those who are doing arbitrage orders cannot continually send one order in and then cancel it, send another order in, cancel it, send another order in, cancel it. Not in the Chinese markets. You have to do that on the international leg, and then what you send to the Chinese leg is really an order that needs to be filled. And that's the order that's going to sweep the market to establish maybe your arbitrage position. So order to cancellation ratio is again published on the Chinese websites. It's low compared to what you expect. So the final two issues that I should mention. Large amount declaration limit. So to prevent spoofing, those kind of issues, the exchanges have a large amount declaration limit, which is if you are putting in an order of say 300 lots and then you cancel it, and then you put 300 lots in again and then you cancel it, the exchange will spot what you're doing and will be interested in why you are doing it. And so there is a limit. Again, it's not particularly high. It varies from exchange to exchange, and last time I looked, it was around 300 lots. So they have a very strict oversight on the sizes of orders going in and whether they are constantly cancelled or not. Now, the last issue, and this particular on trading limitation, should I say, is that in many of the contracts in China, they have no roll contracts. So you cannot trade December to January as a spread. It doesn't exist. There's no contract type like that on the exchange. So if you want to do a roll, if you're long December and you want to roll it forward, then you have to do it manually. You'll have to trade your December and buy your forward month manually. Now that is not that efficient when you're using, just going by eye, so to speak. So the way to deal with that is to use the spreader and set the spreader to roll from one month to the next as you require. That's what everybody else does. That's how it's done in China. And so essentially, if you're going to start start trading the Chinese markets, you need a piece of software from your ISV that includes a spreading capability, an auto spreading capability, so you can deal with rolling contracts. So, in conclusion, we've made 3 videos. The first one looked at the background of the Chinese futures markets, the liquidity, the size and the development of those markets, and hopefully gave you a rationale as to why you should trade the Chinese markets. The liquidity and the arbitrage possibilities are there. And part of the role of BANZ Financial, my company, to give them the tools through which they can invest into these markets. So part 2 looked at the available routes into the Chinese markets. And we looked at the WFI structure, and looked at the weaknesses of that. And then we looked at the overseas intermediary mechanism and looked how that tries to address those issues, particularly about currency transmission. And it does that successfully, but is limited in the number of commodities that can actually be traded. Through the overseas intermediary mechanism, at the moment there's only 7 commodities, but it's a rising number. So in this video, we looked at the issues arising from trading into the Chinese futures markets. Now these are, there are several, which I've outlined earlier, but perhaps the most significant for me is the issue about wash trades. That is a regulatory issue. The other ones are more like best market practice. Now, I hope through the combination of these 3 videos that you've got a really good understanding of how these markets are different, but you've also got an understanding of what the opportunity is. And the opportunity is in my estimation, is vast. And that opportunity is going to expand throughout the next 5 years, without a doubt. In the very first video, I said that I cannot make you an expert, but I hope that I've given you a rationale on why to trade these Chinese commodity markets. I hope I've given you an overview of the routes available and an overview of the tools through which you can address and trade the Chinese markets. And finally, I hope I've outlined some of the issues that arise from using those tools. You are perhaps not an expert, but you know now how to ask the questions, who to ask the questions, and know what questions you should address to trade successfully in the Chinese markets. And it's a tumultuous time. I wish you the best of health.